Good evening, ladies and gentlemen. It's a pleasure and honor to be here at AIFA Kochi Ignite. Thank you to the AIFA team for having me. So I know it's been a long day. You've been through, I think, something like 13 presentations. So I'll try to keep this quick and short. So firstly, I want to start with a little background on Taurus Mutual Fund. We're the second private player to enter the mutual fund space way back in 1993. We focus only on active equity, and we're backed by the HB Group, which has a history of 80 years in financial services and hospitality. And with this long history of stability and expertise, we focus on what matters most for investors, which is creating value through equity investing. So now you might ask, why focus on equity? And it's undisputedly the best asset class to be in despite the volatility. The long-term annualized CAGR of equity is 12.8%, and gold is the next best at about 8.5%. But even though it seems like only 4 or 5% is small, over the course of the last 30 odd years, equity has done 3x better than gold, right? So regardless of our Indian psyche and our love for gold, FD and bonds, equity is where the long-term cornerstone of wealth creation is at. And that's where we think there's the opportunity to help you and your clients harness the power by focusing on equity. So we often hear about, the sirens of market timing. There's so much bad stuff happening all over the place. Asian financial crisis, global financial crisis, various wars, scams, COVID happens. And so you're tempted, let me just pull out some money at this point in time and try to see if I can time the market. And there'll always be a reason not to buy. But the data shows that, you're better off just taking the whole ride. Why? Because if you miss just 50 days, which is 50 out of 7,191 days, or 0.7% of all trading days, you'll end up decimating your CAGR from 12 odd percent to 3.3%. You won't even beat inflation anymore, right? So do you really want to take that risk? Now let's think about, maybe you think that I can time these 50 days. So when was those 50 days happen? Most of them come right in the aftermath of a time where you would normally not be investing, right? So 2008 financial crisis is a third of these days, it's 15. COVID had 3 or 4 of these. The dot-com boom and then the bust had 10 of these combined. So every time there's something bad happening, the recovery is just as strong, right? Because eventually life moves on. And that's what sort of matters. So what I want to focus on next is the life cycle of investors' emotions. Investing is just as much about managing your emotions as it is about managing or knowing as much as you want, right? Peter Lynch famously said, everyone has the brains to make money in stocks, not everyone has the stomach. So why is that? Look, bull markets start in desperance and despair. Then they're followed by disbelief, right? Is this happening? They famously climb walls of worry. Then you finally have hope. Yeah, good things can happen maybe here. Finally, you're optimistic. It's officially a bull market. Soon, there's excitement in the air. Everyone's asking you, regardless of the profession, hey, should I be investing in the stock market? Finally, you get to euphoria, which is when everyone's asking you, hey, you should buy this stock. It'll do well. Trust me, I already made this much money on it. And suddenly there's, a small dip in the market and there's denial. Markets don't go down, do they? This follows anxiety. Oh, I think I might be looking at a loss here. Eventually you have fear because now you are looking at a loss. The question is how much. Then there's panic and you see selling across the market. And eventually as that selling's exhausted and everyone's in despair and desperate, the cycle begins again, and that's when you should be buying what everyone else is taken through. So what does the average investor's experience emotionally look through in the market, right? First you start out with entertainment. This kind of seems fun. It's the same attitude that you have to the casino. I'm going to go gamble a little bit of money, try to see what it's like. Then you experience, I want to be options and futures and stocks and all these other types of instruments to try to play the market. Eventually you get frustrated, right? You aren't seeing the returns that you expected. The magical 100x just isn't happening. Then you come to the realization that, this is the way to go. I should have a long holding period, invest in common stocks. Maybe, mutual funds aren't that bad after all. Might be the best thing. And that's where, they probably give you a call. And that's where you help them get to the wealth creation stage. So look, my macro prediction broadly is we'll see 7 to 8% real GDP growth over the next 20 odd years. That's a 3 to 5x in GDP. Why? Because look, demographics are skewed super young. We have 500 million people that are educated, that speak English, that can participate in the global economy. So if you think one United States is powerful, we have two of them within India. Together, what that leads to is, I think Nifty 50 can go to 1 lakh by 2035, and let's say 2 to 2.5 lakh in the next 20 odd years. So the question is, how are you going to take advantage of that, right? There's two things that are in your control: your savings rate and your holding period. Everything else outside of that, including what the market will give you, is really not in your control or in your client's control. So there's 5 scenarios highlighted here. I just want to focus on 2 important things here. When you double your savings rate, it impacts returns in the long run much more than even the return from the market doubling. And then the second thing, as the holding period increases, that compounding benefits itself, right? So we have a beautiful, and then if you add on top of the doubling, if you step it up, right, using a step up SIP, just increase by 10% every year, the last scenario. Just look at the kind of magic that happens, right? It's more than double just increasing savings on its own. So the other part of this is also, not everything's about money. Do you really want to spend your life working 9 to 5 and then working 5 to 9 to figure out which stock's going to work? Or do you want to enjoy the nicer things in life, spend time doing hobbies, spending time with family, friends, however else? If you are the type that want to spend 5 to 9 working on the stock market, please do give me a call. We're always hiring. So with that, I want to focus on our investment framework. It's a word beloved by every investor, which is profit. If you know someone, again, that doesn't, please tell them to give me a call. Happy to trade with them. We love people who like losses. So the first idea is probabilistic, right? Which is, I'd much rather any day of the week take a 15% return if I have a 90% chance of making it, because that's 13.5%, rather than having a 10% chance at making a double, because that's 10% at the end of the day, right? The other idea we have is reflexivity. Markets change, facts change. If the facts change, we'll change our mind, right? Markets are dynamic. Sectors that used to be not so good, like defense 5 years ago, if I told you we're launching a defense fund, you'd probably hurl tomatoes at me. But today, defense isn't work because the facts change, right? We're opportunistic. We try to be contrarians, not on quality, but on price. So wherever we hear someone say something along the lines of, this always works or this never works, we'll be there, we'll dig, we'll try to see if something makes sense. We think from first principles, which means we question every assumption, similar to this idea, right? Like, this always works. Well, what if it doesn't? This always happens like this, similar kind of idea. Then the other idea is we bring together a lattice work of mental models from physics, from history, biology, maths, and all these other domains, which enable us to make better investment decisions. How so? For example, psychology, there's this idea, which all of you must be familiar with too. In some ways, it's called anchoring bias. Oh, I bought the stock at 100, it's now 200, it seems too expensive. Earnings might have caught up. Actually, at 200, it's cheaper than it was at 100. But in your mind, you have that anchoring bias. It was at 100 only, na? Then the last part is, of course, thoroughness, which I think is a quintessential aspect of all equity investing. We'll leave no stone unturned to make sure that we have the right information and we have the right take on the thing. So let's say our flagship or standout product is a Taurus Ethical Fund, which is our Sharia compliant offering. The idea is for socially cautious people who want to focus on high quality companies without the hassle of doing it themselves, right? So we've also extended this a bit further, and we said we want to remove all vice, right? So there's no non-veg in it, there's no gambling, there's no alcohol, and there's no cigarettes. So now everyone says, look, hey, I invest in high quality companies, so why should you believe me? You really shouldn't, right? First principles question everything I throw at you with skepticism. So how would you judge a high quality company? You might ask it to have a good ROCE. Well, we do better than the benchmark there. A gross margin, operating margin, free cash flow conversion, cash conversion ratio, you name it, and we beat the average benchmark there. And what should be noticed is we're not just investing out of those 303 companies, we also remove those additional vices out. So we invest in about 270 odd, right? So even after additional filters, we're able to manage and pick better companies out of the benchmark. So, we're currently at this point in time where everyone seems to think that, why invest in large cap? It's a diversification, right? Traditionally, you would expect across size, style, factor, diversification within equities. But why should I do it right now? Mid cap, small cap are just so much better. So what tends to happen is every market, including India, goes through cycles where as the bull market gets going, your small and mid cap stocks tend to do much better, the CAGR is much higher. Eventually, the time comes where the market take a tumble, and that's where mid caps and small caps will give away a lot of the gains, or even sometimes most of the gains that they have taken during this upswing in the downturn, whereas large cap won't. Now, there seems to be this misconception of sorts that all types of equity are correlated, right? But what tends to happen is large cap is not related to mid and small. Mid and small are correlated to each other, and then the time period where large will get different from mid and small is during corrections. If you just take a look, it's around 2008, it's around 2000, it's 2020, where you see that differential start coming in, right? And that's where large caps falling less will help you create what we call enduring alpha. So the moral of the story here is, I think it's a prudent time to be in large cap when elephants dance, much like the tusker charging in the forest. Regardless of whether you're a lion or a gazelle, you're getting out of the way. Now, we sort of already covered the metrics of the kind of companies that we have in the ethical fund. The only difference in our large cap fund is we also, of course, add banking and NBFCs, right? Which you can't have in the ethical fund. So how does that subsection of the portfolio look? And like again, on book value per share, on ROE, on net interest margin, on capital adequacy, NPAs, anything that you want to take a look at, the 5 companies that we choose tend to do much better than the benchmark on average. So with that, thank you for your time. I'll yield the remaining time to anyone who has any questions.
Any questions on Taurus Ethical Fund? It's a Sharia-based product offering. He has been very clear. No cigarettes, no non-veg, no interest-giving thing also, no, right?
Yeah, so no banks, no NBFCs.
No banks, no NBFCs, no and one of the best performing.
So, yeah.
Please do have a look at the Taurus Ethical Fund, which is a fund having a real long vintage.
Yeah, so since inception, I think compared to across the landscape, 1, 3, 5, whatever time period you want to look at, we're the best performing instrument in that field.
Especially if you have clients who believe in the Sharia-based investing concept, one could look at their ethical fund, which Mr. Kanishk Kapur has been harping in. And we also do fervently hope and feel that you will be coming with more product offerings in the days to come.
Definitely with your support, why not?
Kerala needs your presence also, sir. Once upon a time, you were present in Kerala. Now your presence in Kerala is not there. Yeah. You have to come back
again, right? The chicken goes, the egg comes where the chicken is. So as long as there's business, we'll be there.
The chicken and the egg story is always controversial, but then we'll have to draw the line somewhere. So thank you so much, Kanishk ji. Please stay there, sir. Now, can we have the honors of calling on stage the CEO of Taurus AMC, Mr. Prashant Soni ji, to join Mr. Kanishk Kapur, who is the whole-time director on CIO of Taurus Mutual Fund. Also, can we have Mr. Anuj Kapil, Senior Fund Manager, Taurus Mutual Fund, and also Mr. Tulsi Raghavan, Sales Head South of Taurus Mutual Fund, to kindly join Kanishk ji on stage. We have a lucky draw now, to be one draw each by each of you, sir. The first number is 102. 102. Okay, the next number 125. 125. 018. Yeah. Mr. Jomi DJ, the king of Karimandol from Todupuzha. Next number 389. 389. Yeah, please come, sir. No problem. Next number 177. 177. One six two. 162. It's okay, I think we'll have to leave it at that. Thank you so much. And now can we have Mr. K. Sethu Madhavan of AIFA Kozhikode chapter to kindly come forward and hand over the token of appreciation from the side of AIFA to Kanishk Kapur ji. Can we have Mr. Benzi Thomas to kindly come forward and hand over another appreciation token to the CEO Prashant Soni sir. And can we have Sam Kochi to kindly come forward and hand over our gift to Mr. Anuj Kapil, Senior Fund Manager, Taurus Mutual Fund. We are so proud that three very, very senior officials from Taurus Mutual Fund, they have flown down to Kerala. That shows the commitment they hold in their minds towards expanding their business in this part of the country. This is God's own country, so please don't forget.